All right, so today we're going to be doing a deep dive into dividend stocks in 2025. And we've got this really cool blog post that we're going to be taking a look at
Sounds good.
from an investor who breaks down their approach to dividend stocks. And they've got like these three main categories that they focus on.
Right.
And they got some really cool examples too, which is always nice to have those like concrete examples to look at.
Yeah, always helps to ground it a bit.
Yeah, totally.
Yeah.
So they're looking at those, the ride or die blue chips, the high yield stocks, and then those high growth stocks.
Nice. So a little something for everyone.
Yeah, I like it. And they've got, Coca-Cola, British American Tobacco, and then Equinix.
Oh, those are some interesting picks for sure.
I know, right? So I'm excited to dive into this and see what we can learn.
Yeah, let's do it.
Okay, so first up, this investor really emphasizes those like core blue chip stocks.
The classic.
The classics, yeah, the ones that you're like, all right, I'm holding on to you no matter what.
Exactly, the bedrock of so many dividend portfolios.
Yeah, and they explain why they favor those blue chips, and it's not just about like, oh, they pay dividends. It's more than that.
Oh, for sure. It's about stability too, right? Like these companies have a history of performance. They've weathered the storms. They've come out on top.
Yeah, they've proven themselves.
Yeah.
Which I think is really reassuring to a lot of investors, especially when it comes to dividends. You want that consistency.
Absolutely. Consistency is key. And, this investor also points out how well blue chips fit with strategies like dollar cost averaging.
Oh, yeah. That makes a lot of sense.
So, consistently buying shares over time, regardless of what the market's doing.
Takes the emotion out of it.
Exactly. It's a really disciplined approach. And then you add in the power of compounding when you reinvest those dividends.
Oh, yeah. The magic of compounding. It's like watching your money grow while you sleep.
And it's all about the long haul, right? That classic get rich slowly philosophy.
Slow and steady wins the race sometimes.
Oftentimes, actually.
Okay. So this investor, their prime example is Coca-Cola.
Ah, a classic blue chip.
Yeah. And they've held it since 2011, which is serious commitment.
Wow, that's impressive.
I know, right? But what's interesting is that Coca-Cola, they're not just some stagnant giant.
Right. They're still finding ways to grow.
This investor points out their 2024 performance, 6% net revenue growth for the quarter, 3% for the full year.
Solid numbers.
Yeah, but then you look at their organic revenue growth, it's even more impressive, 14% for the quarter, 12% for the year.
Wow, that's significant.
That means they're not just relying on acquisitions or price hikes. They're actually selling more product.
It's like that familiar red can just keeps on selling.
But it's not just about the red can anymore, right? They're innovating, they're expanding.
Yeah.
They've got all these different beverages now.
Yeah, they've really adapted to changing consumer preferences.
It's like they figured out how to stay relevant.
Yeah.
Probably a big part of why they've been able to outperform the market for so long.
Makes sense.
And this investor also highlighted their EPS growth, and they had a nice increase in free cash flow.
Which shows they're managing their money well.
Exactly. All signs point to a company that's not just surviving, but thriving.
A true blue chip in action.
All right, so that's the ride or die strategy in action.
But this investor doesn't stop there.
Nope. They also have a taste for a bit more spice.
Oh, this is where things get interesting.
Which leads us to their high yield stock picks.
Let's dive into those.
Okay, so high yield, high risk, high reward.
Well, maybe.
Tell me more about why this investor likes this category. I mean, those juicier dividend payouts are definitely attractive, especially if you're looking for income right now.
Oh, absolutely.
But this investor makes it super clear that you can't just jump in blindly with high yield stocks.
No, you got to be careful.
Right, because higher yield often means higher risk.
Exactly. And they really stress the need to be selective about your entry points.
So it's not just about chasing that big yield number.
No, it's about finding those opportunities where a high yield stock might be trading at a discount that gives you a margin of safety.
So you're looking for value, too, not just yield.
It's about finding that sweet spot between the two.
I like that. And here's another thing that's interesting. This investor doesn't automatically reinvest dividends from those high-yield stocks.
Oh, really? That's different.
Yeah, I thought the whole point was to reinvest and let that compounded magic work.
Oh, well, they prefer to have more flexibility with that cash flow.
Okay, so it's more of an active approach.
Exactly. They might use it to diversify their portfolio further or maybe even explore other investment opportunities.
So they're keeping their options open.
Right. It's like they're saying, I'm taking some chips off the table and seeing what else is out there.
That's a good way to put it. So what's an example of a high-yield company this investor's into?
They actually hold British American Tobacco, or BTI.
BTI. Okay.
Which, as we know, comes with its own set of challenges.
Yeah. The tobacco industry faces a lot of scrutiny.
And that's reflected in BTI's high yield.
So it's a risk factor for sure, but they're still generating consistent cash flow.
That's the key. And their recent earnings actually show they're adapting to the change in market. They achieved 1.3% organic revenue growth.
Which isn't huge?
Right, but their newer product categories like vaping and heated tobacco saw a growth rate of 8.9%.
So not just relying on traditional cigarettes anymore.
They're diversifying, trying to appeal to evolving consumer preferences.
Kind of like Coca-Cola in a way.
Exactly, adapting to stay relevant.
What about their dividend growth?
It's been slow and steady, a recent increase of 2%.
Not massive, but still an increase.
And remember, we're talking about a company with a really high starting yield, so even a small increase on a large yield can make a difference.
Yeah, that makes sense. Okay, I'm starting to see why this investor likes BTI.
High yield, some growth potential, and a company that's trying to adapt to a changing world.
What has their experience been like with BTI specifically?
Well, they bought most of their shares around $33,
Okay.
locking in a 9% dividend yield.
Wow, 9%, that's a lot of cash flow.
And they mentioned that even though the stock price has fluctuated, they're still ahead thanks to that smart entry point.
So they're thinking long term.
Focusing on the income stream rather than short-term price movements, and BTI currently makes up over 5% of their portfolio and contributes a significant 11.47% of their total dividend income.
So it's a real contributor.
And remember that strategy of not reinvesting those high-yield dividends.
Yeah?
This investor actually aims to recover their entire initial investment through those dividend payments over time.
So everything after that is basically house money.
It's a way to mitigate the inherent volatility of high-yield stocks.
Pretty smart risk management.
They're getting that immediate income while potentially reducing their overall risk.
All right, so we've covered the ride or dies and the high yield plays. Now let's talk about the third category, those high growth dividend stocks.
Okay.
These are the ones that could really supercharge a portfolio over the long haul.
This is where we see the investor's vision for the future. They're looking for companies with strong growth potential, and that means both dividend growth and capital appreciation.
Companies that are disrupting industries, innovating, riding the wave of major trends.
Exactly, and the time horizon gets even longer here.
Oh yeah, this isn't about quick games.
No, it's about planting seeds and watching them grow over years, even decades. The initial dividend yields might not be as high, but the potential for growth is huge.
So it's a trade-off. You're accepting a lower yield up front in exchange for the potential for those dividends to grow significantly over time.
Along with the stock price.
It's that classic total return approach.
And the compounding effect of reinvesting those growing dividends becomes even more powerful over a long period.
It's like a snowball rolling downhill, gathering more and more snow as it goes.
Perfect analogy.
I love that. So which company is this investor excited about in the high growth space?
It's Equinix.
Equinix.
EQIX.
Yeah, EQIX.
Okay, I've heard that name.
Yeah, it's a real estate investment trust. So REIT.
So they own property.
Right, but not just any property. They specialize in data centers.
Data centers, with all this talk about AI and cloud computing, those must be in high demand these days. Oh, yeah, absolutely. It's like they own the digital real estate everyone needs, but not everyone can just, build a data center.
Makes sense. So they position themselves well to benefit from this whole tech boom.
Totally. And this investor is really impressed with their 2024 performance.
What were some of the highlights?
Well, for starters, they had an incredible 22 consecutive quarters of revenue growth.
Wow. 22 quarters in a row.
Yeah, and their annual revenue was up 8%, which is solid, and their adjusted funds from operations, or AFO, also saw a healthy 10% increase.
Neat. A few.
It's basically how we measure a REIT's cash flow. You can think of it like the REIT version of earnings for a regular company.
Got it. So it tells us how profitable they really are.
Exactly. And a 10% increase in AFO is a pretty good sign that they're doing well.
So growing revenue, strong cash flow in a booming industry. What's not to what about the dividends, though?
Well, they recently increased their dividend by a solid 10%.
10%. That's not bad at all.
Shows their commitment to sharing their success with shareholders.
But I remember this investor mentioned that Equinix has a pretty low dividend yield, like 2%, something like that. Why accept such a low yield when you could be chasing those 9% yields with BTI?
Right. Well, that's the trade-off with high-growth stocks.
Yeah.
You're sacrificing some immediate income for the potential for much higher returns down the road.
It's a bet on the future.
Exactly. Equinix is trading at a higher valuation because the market expects them to keep growing rapidly, and their strong revenue and earnings growth seem to justify that valuation.
This investor seems to believe that Equinix growth will continue leading to bigger dividends and a higher stock price over time.
They're planning to initiate a position in EQIX, soon adding it to their existing holdings in companies like Alphabet.
Okay, so they're not just talking the talk, they're walking the walk.
And, they acknowledge that time in those high-growth stocks can be tricky. But they believe that Equinix has a strong competitive advantage in the data center industry that will sustain its growth for years to come.
It's like they're saying, I'm getting in on the ground floor of the next big thing.
Absolutely, and that's the exciting thing about high-growth investing. You're participating in the innovation and disruption that are shaping our future.
I like that. So we've covered a lot of ground today. Blue chip stability with Coca-Cola, high yield income, with BTI and future growth potential with Equinix.
Mm-hmm.
It's really cool how this investor has built such a diverse dividend portfolio, balancing risk and reward according to their own goals.
And what's really inspiring is that they're not afraid to adapt and evolve their strategy. They're planning to allocate more towards those high-growth stocks. As their portfolio matures, shows that they're always thinking about the future.
It's a good reminder that investing is a journey, not a destination.
Totally. You constantly learn, adjust, and refine your approach as you go.
So for all of you listening, what resonated most with you today? Did you find yourself leaning towards those stable blue chips, those tempting high yielders, or those exciting high growth companies?
Or maybe a mix of all three.
That's the beauty of it. There's no one-size-fits-all answer when it comes to dividend investing.
The best strategy is the one that aligns with your personal risk tolerance, your financial goals, and your time horizon.
We'd love to hear your thoughts. Investing is a personal journey, and we're all here to learn and grow together.
Absolutely. So keep those questions coming, and we'll keep diving deep into the world of investing.
Until next time.